Okay, let's get right into it. A major geopolitical shock has just hit the world stage, and everyone wants to know, what's it doing to the markets? In this explainer, we're going to cut through all the noise and show you exactly how the financial world is reacting right now.
So this is the core of it, right? A new global conflict erupts. How do financial markets actually respond? Is it just blind panic, everyone selling everything, or is it something more calculated? Well, let's follow the money and see what it's telling us.
All right, so here's the setup. A really significant attack has just threatened one of the most critical trade routes on the entire planet. We're talking about a major choke point for global commerce, and that creates a ton of uncertainty instantly.
And if you want to understand why this is such a big deal, just look at this number, 20 million. That's how many barrels of oil pass through this one strait every single day. I mean, that is a huge chunk of the world's energy. Any hint of a disruption there, yeah, you're going to see consequences, and fast.
So naturally, the first place we have to look is oil. It's always on the front lines when something like this happens. The reaction in oil prices can tell us a lot. So was it a massive out-of-control spike? Let's take a look.
And whoa, there it is. Right at the market open, we saw a big jump, an 8% spike. Now that looks dramatic for sure, but here's what's really interesting. It's already pulled back a bit. It didn't just keep screaming higher, and that is our first really important clue about what the market is actually thinking.
And to really put this into perspective, that 8% jump, it sounds like a lot, but in the grand scheme of things, historically, it's only the 53rd largest single-day spike. It doesn't even make the top 50. So what does that tell you? It tells you the market is concerned, yeah, but it's not in a full-blown panic, not even close.
All right, so oil is showing some, let's call it contained concern. What about global stocks? Are equities on edge? Are we seeing a synchronized downturn all over the world? Let's dig in.
And yep, take a look at this. The red is pretty much everywhere. Japan's Nikkei, down. Europe's DAX, a minor decline. The S&P 500 here in the US, down about 1.3%. But look at those numbers. A 1.3% drop is not a crash. It's what the market calls a corrective phase. It's a pullback, it's caution, but it's not a head for the hills moment.
Okay, so whenever there's this kind of uncertainty, money gets scared. And scared money does one thing. It runs for cover. This is what we call a flight to safety. The question is, in a crisis like this one, where does all that capital flow? Where's the safe harbor?
And here's your answer. It's flowing straight into the US dollar. This is classic textbook stuff. The US dollar index, which is basically a measure of its strength against other currencies, blew past the 98 mark. That's a huge vote of confidence when things get scary. And it's not just a general trend. You can see it specifically. The dollar's getting stronger against the Chinese yuan, stronger against the Japanese yen. Those BRICS currencies we hear so much about, they're pulling back. And you know what's really interesting? Bitcoin, the so-called digital gold, is basically unmoved. It really shows you that when the chips are down, the US dollar is still the world's ultimate safe haven.
All right, let's move on to what a lot of the pros would say is the most important signal of them all. Seriously, you can get distracted by the daily swings in stocks, but the bond market, that's where you find the really smart money's verdict on the economy.
And the key indicator we're talking about is the U.S. 10-year Treasury bond. You can pretty much think of it as a loan you make to the U.S. government, which makes it one of the safest assets on Earth. Its yield, the interest rate, is basically a barometer for long-term economic expectations. It tells us everything.
Okay, now this is the key slide. This is the whole ball game right here. If the market was truly terrified that this oil spike would cause massive inflation, what would you expect? You'd expect bond yields to spike higher, right? But look at what's actually happening. Yields are falling a little. They're holding steady. That tells us investors are buying bonds for safety, not dumping them out of fear. The bond market is calm. This is a huge signal.
Okay, so let's step back and put it all together. We've looked at oil, we've looked at stocks, currencies, and most importantly, the bond market. So what's the big takeaway? What is the market trying to tell us when we synthesize all these signals?
You know what's really amazing is how consistent the message is. The oil reaction was big, but historically it was contained. Global stocks are in a correction, not a crash. The US dollar is the go-to safe haven, just like you'd expect. And the bond market is showing absolutely no signs of major stress. The whole system is holding up.
So the market's message is loud and clear. This is serious, yes, but it is not a systemic crisis, at least not yet.
And that leaves us with a really fascinating and maybe slightly unsettling question to think about. In a world that feels so volatile, if this event didn't break the market's calm, what's it going to take?